They were not just workers. They were not only the backbone of the plantation economy. To the banks and businessmen of early America, enslaved people were something far more chilling. They were money. A man, a woman, even a child could be listed on a balance sheet, pledged as collateral for a loan, mortgaged like land, or repossessed like livestock. The flesh of human beings was turned into financial security, traded in ledgers and leveraged to build fortunes that still echo today. While plantations told one story of slavery, Wall Street, insurance companies, and banks told another. A story of human beings transformed into currency, into numbers on a page. This is the hidden history of how slavery was not only brutal labor, but also a financial system, one where enslaved people's bodies became the currency of flesh. In these financial arrangements, enslaved people were meticulously documented. Ledgers listed names, ages, gender, physical condition, and skills. Some contracts included detailed notes on health, temperament, and breeding potential. Children as young as 5 were included, valued not for what they could do immediately, but for the labor and reproduction they could provide in the future. Entire families were often used as collateral, yet there was no recognition of familial bonds. Parents and children, siblings and spouses could be separated at the whim of the ledger. The process of securing loans with human collateral was disturbingly precise. A planter might walk into a bank in Charleston, Richmond, or New Orleans presenting a list of his enslaved property. The bank would assign a monetary value based on the individual attributes listed. For example, a strong male field hand age 25 might be worth more than a field hand age 40. Women capable of childbearing were valued for both their labor and future offspring. Skilled laborers like blacksmiths or carpenters commanded higher sums. Children were considered investments in the future workforce. The auction block is the image most people associate with slavery: the shouting of buyers, the inspection of enslaved bodies, the hammer falling to seal the sale. But what many do not realize is that for enslaved people, captivity extended far beyond the plantation or auction house. Long before the whip or the overseer, their lives were written into contracts, mortgages, and ledgers. To the banks and businessmen of antebellum America, enslaved people were not merely workers, they were currency, pledged as collateral to finance the growth of a nation. By the early 18th century, Southern planters were increasingly dependent on credit to fund expansive plantations. Land had to be purchased, tools and animals acquired, and labor secured. Cash was rarely sufficient to cover all expenses, but banks and private lenders were willing to extend loans, provided there was adequate collateral. The most valuable collateral was not land, not crops, but human beings. The value of enslaved people on paper was immense. By 1860, estimates suggest that enslaved individuals were collectively worth over $3 billion, exceeding the combined value of factories, railroads, and banks in the United States. Human beings were not only property, but the largest financial asset in the country. This immense monetary valuation made the use of enslaved people as collateral both common and highly lucrative. The legal and social framework ensured that this system could function. Courts upheld contracts pledging enslaved people as security. The law treated them as property rather than persons. When a planter defaulted, the process was swift. Bank officers would inspect the pledged individuals, sometimes employing appraisers to determine exact value, and then oversee the sale to recover the loan. These acts of financial enforcement were conducted with the same rigor as repossessing land or livestock. If a planter defaulted on the loan, the consequences were devastating. The bank had legal authority to seize the enslaved individuals listed as collateral and auction them to satisfy the debt. Entire families were torn apart. A father could be sent to one plantation, a mother to another, and children scattered to different buyers. Enslaved people lived under the constant threat of sale, not just from their owners, but from the financial institutions that had a legal claim over their bodies. Northern banks, investors, and even some insurance companies participated in this system. While the labor of enslaved people was primarily in the South, the money, credit, and financial products built around them often flowed through New York, Boston, and London. Letters and contracts show that Northern lenders financed Southern plantations by using enslaved people as collateral, turning human lives into the backbone of financial transactions across continents. In addition to loans, some enslaved individuals were insured. Companies like Lloyd's of London and several US-based insurers offered policies to protect slaveholders from financial loss due to death, illness, or escape. Insurance policies reinforced the idea of enslaved people as economic assets rather than human beings. The policyholder received monetary compensation if the investment failed. The enslaved, meanwhile, had no agency, no recourse, and no protection. These financial mechanisms allowed the plantation economy to expand rapidly. Credit extended against human lives fueled the purchase of more land, more enslaved workers, and more tools. It became a self-reinforcing system. Enslaved people were both the source of wealth and the guarantee of future financial expansion. Mortgages, contracts, and ledgers created a cycle in which bondage and credit were inseparable. The human consequences were catastrophic. Families were divided, futures rewritten, and individuals forced into new plantations or labor contracts against their will. Imagine a mother waking one morning to find that her children have been seized by the bank, moved hundreds of miles away, leaving her alone in the world. Imagine a teenager counted as collateral, being sold to satisfy debts he never incurred. The ledger and contract abstract on paper, translated directly into suffering, fear, and loss. Beyond the individual stories, the financialization of enslaved people had broader economic implications. Banks and lenders increasingly saw slavery, not just as labor but as an investment system. Loans backed by enslaved people could be sold, traded, or bundled into larger financial instruments. The economy of bondage extended far beyond plantations. It became the lifeblood of credit, commerce, and even Wall Street speculation. The effect on enslaved communities was devastating. People lived under constant financial threat. The slaveholders' debts and the bank's claim to their lives were inescapable. Repossession and auction were always possibilities, shaping behavior, family bonds, and daily survival strategies. This invisible chain was as binding as the physical chains used to enforce labor in fields or workshops. Enslaved people were also aware of the market logic. Some resisted by running away, attempting to escape the financial system as well as the plantation. Others tried to protect family members, negotiating or pleading with overseers or bankers, though success was rare. The very idea that a human being could be counted as collateral and traded in a financial transaction shaped the psychology of bondage, instilling fear, obedience, and hopelessness. The numbers only tell part of the story. Behind each line item in a ledger was a life, someone who experienced fear, grief, and uncertainty. Many enslaved people understood that their bodies and labor were valued monetarily, yet few could grasp the full scope of being human collateral in a financial system. Children were educated informally in the constant risk of being separated or sold. Adults knew that default could lead not only to their own sale but to the dispersal of their families. The scale of these operations grew over time. By the antebellum period, large Southern banks specialized in slave-backed loans. They employed clerks, appraisers, and legal experts to manage the collateral. Some banks had entire floors dedicated to mortgages secured by enslaved people, with filing systems meticulously tracking each individual pledged. Letters and account books show a highly organized system, with planters, bankers, and attorneys coordinating to maintain the flow of credit. New Orleans presents another example of the intersection of finance and slavery. Banks there issued loans backed by enslaved people working in sugar plantations, whose labor produced some of the world's most valuable commodities. In many cases, northern investors provided the capital, while southern planters pledged human collateral to secure repayment. The enslaved themselves were unaware of the full scope of these arrangements. To them, each day was a struggle for survival, yet their existence was a key pillar of an elaborate financial network spanning cities, states, and even continents. The banking practices of Richmond mirrored those in Charleston and New Orleans. By the 1840s, several institutions maintained floors dedicated entirely to managing slave-backed credit. Appraisers assessed individual enslaved people, calculating monetary value based on age, health, and skills. Banks considered this a safe investment. Unlike crops or livestock, enslaved people could reproduce, providing future laborers. They were, in the eyes of finance, self-renewing collateral. As the cotton economy surged, so too did the financialization of enslaved people. By the 1820s and 1830s, banks and private lenders increasingly specialized in loans secured by human collateral. What began as individual mortgages evolved into complex arrangements, sometimes involving dozens of people pledged in a single transaction. Entire enslaved families could be bundled together in one loan, stripped of any legal recognition of their familial bonds, and offered as security for debts far larger than any one plantation could cover. In Charleston, South Carolina, the city's counting houses were filled with ledgers detailing the pledged bodies of the enslaved. Clerks meticulously recorded age, sex, skill, health, and even reproductive potential. The language was clinical. George, male, 23, field hand, sound and healthy. Mary, female, 21, childbearing, good character. Contracts often included multiple generations, parents, children, even infants, treated as a single financial package. Planters used these loans to expand holdings, purchase more land, or buy additional enslaved workers, further entrenching the system of bondage. The consequences for the enslaved were profound. Individuals and families could be repossessed multiple times throughout their lives, sold to satisfy loans they never incurred, and separated from loved ones with little notice. Imagine a family bound together for generations being torn apart because a planter defaulted on a debt. The financial system made such destruction routine, a predictable and legal outcome of credit arrangements. Northern banks and investors were also implicated. Money lent from Boston or New York, often invested in southern plantations, relied on enslaved collateral for security. Letters and contracts reveal a network of financiers who never set foot on a plantation, yet profited from the labor and lives of enslaved people. Wall Street in its early years was intimately connected to this trade, demonstrating that slavery's influence extended far beyond southern fields. Some banks went further, facilitating the buying and selling of debt secured by enslaved people. Just as modern mortgages are bundled into securities, southern banks occasionally sold or traded loans secured by human collateral. These practices demonstrate how deeply slavery was embedded in the financial system. Human lives were commodified not only for labor, but also for complex financial speculation. Insurance companies also played a role. Policies covering the lives of enslaved people were common, protecting owners against death, illness, or escape. Companies such as Lloyd's of London and several US-based insurers profited from these arrangements, treating human life as an insurable asset. The policyholders received compensation if the enslaved person died or became otherwise unusable, while the individual had no protection or agency. This insurance system reinforced the perception of enslaved people as property, further intertwining human suffering with economic gain. Families lived in constant uncertainty. The fear of being seized by a bank created psychological trauma in addition to physical suffering. Parents feared for their children. Children feared for their parents. The ledger entries that determined their fates were incomprehensible to most, yet their consequences were immediate and irreversible. To exist as collateral was to live in perpetual financial bondage, a secondary chain atop the physical chains of slavery. This system of human collateral was instrumental in expanding plantation economies. Loans backed by enslaved individuals allowed planters to acquire more land, tools, and laborers, creating a feedback loop that perpetuated slavery. Human lives became both the foundation and the engine of economic growth, demonstrating how financial systems can institutionalize human suffering while generating vast wealth. The value of enslaved people on paper was staggering. By 1860, estimates suggest that over 4 million enslaved individuals were collectively worth more than $3 billion, the largest financial asset in the United States at the time. Human beings were central not only to the production of cotton, sugar, and rice, but to the very system of banking, credit, and investment that fueled the nation's growth. Repossession cases illustrate the human cost. One plantation in Mississippi defaulted on a loan, and a family of 12 was seized by the bank. The father was sold to a plantation in Louisiana, while the mother and children were split among 3 buyers. These were not isolated incidents. Documents from the period show that such dispersals were common, and often documented in legal records and newspapers. Enslaved people became both the instrument and the collateral of financial expansion. By examining these practices, we see that slavery was more than forced labor. It was a financial system built on human flesh. Enslaved people were not just producing cotton or sugar. They were producing credit, collateral, and capital. Their bodies and lives were central to the economic architecture of the United States. shaping banking, lending, and investment patterns for decades. Understanding this dimension of slavery forces a confrontation with the invisible chains of finance. While historians and documentaries often focus on plantations, overseers, and rebellion, the ledger books reveal another layer of bondage, one in which banks, lawyers, and investors were just as complicit as the planters themselves. Slavery was not merely a labor system. It was a sophisticated financial apparatus that converted human beings into assets and wealth. The legal framework supported these practices. Courts routinely upheld the use of enslaved people as collateral. Contracts pledging individuals for debt repayment were enforceable, and banks had broad authority to seize and auction the pledged enslaved if necessary. Enslaved people had no legal recourse. They were property in the eyes of the law. This legal backing allowed the financial exploitation of enslaved people to operate with precision, scale, and devastating efficiency. Even the language used in these documents reinforced dehumanization. Terms like sound, good character, unsound, and childbearing reduced lives to attributes of value. The transactional tone stripped away identity, family, and humanity, converting human beings into abstract numbers that could be leveraged, traded, or liquidated. Slavery was not just a Southern institution. It was a national financial enterprise. While plantations produced cotton, sugar, and rice, banks and investors in cities far from the fields turned human lives into currency, extracting profit without ever touching the soil. Enslaved people became the backbone of an economy that was both brutal and sophisticated, linking the labor of bondage to the machinery of credit, insurance, and investment. By the early 19th century, Northern banks were actively financing Southern plantations. Wealthy investors in Boston, Philadelphia, and New York supplied loans for land, equipment, and additional enslaved labor. These loans were often secured by enslaved people themselves. In a sense, the North and South were partners in bondage. Southern planters supplied the labor, Northern banks supplied the capital, and together they transformed enslaved people into financial assets. The story of enslaved people as collateral is a story of human resilience under unimaginable oppression. Families survived, communities endured, and individuals resisted, even as they were treated as numbers on a page. Their lives remind us that slavery was not only brutal, but deeply integrated into the economic structures of the nation, leaving a legacy of inequality and moral reckoning that persists today. Wall Street, too, was built on slavery. Early securities, bonds, and loans were often backed by plantations and the enslaved people who worked them. Investors trading in northern financial centers could profit from crops they never saw, laborers they never met, and contracts they never signed. The economic engine of bondage extended beyond the South, influencing national finance policy and development. Human collateral was literally embedded in the wealth of early America. Consider the case of the Planters Bank of South Carolina. In its ledgers, enslaved people are listed alongside land and equipment as collateral for loans. Large parcels of enslaved workers could be pledged to secure multiple loans, and the bank routinely repossessed individuals when debts were unpaid. Families were split, futures destroyed, all in the service of profit. Historical documents reveal repeated incidents where individuals were seized multiple times in their lifetimes, illustrating the systemic nature of financial bondage. Insurance companies played an equally pivotal role. As the financial stakes of slavery increased, slaveholders sought protection against the risks of death, illness, or escape. Insurers responded, offering policies that valued human life in purely economic terms. A healthy adult male might be insured for several $1,000s, a woman for her labor and reproductive potential, and children for their future contribution to the workforce. Insurance contracts treated these individuals as property, not people, codifying the commodification of human flesh at the level of corporate finance. One notable example is the New York Life Insurance Company, which in its earliest days insured enslaved individuals. Lloyd's of London and other European insurers also underwrote policies for Southern slaveholders. These companies profited immensely, collecting premiums while ensuring planters' investments were protected. The enslaved themselves had no voice, no recourse, and no recognition as human beings in these contracts. They were assets, insurable and tradable, their very survival tied to the expectations of financial return. In Louisiana, banks provided credit secured by enslaved people working on sugar plantations. Letters between planters and northern lenders reveal complex arrangements. One planter would pledge 100 enslaved workers for a multi-year loan, while another would use a combination of land and human collateral. These arrangements show the sophisticated financial networks that enabled the expansion of slavery, allowing enormous sums of money to flow north, while labor-intensive agriculture prospered south. Insurance contracts added another layer of security for lenders. A planter's debt might be covered not only by the value of the enslaved pledged as collateral, but also by insurance policies on their lives. If a worker died or was injured, the lender and the insurer both protected their financial interests. This created a system in which human suffering was quantified, traded, and protected within the law of finance. Even as the economy grew, the human toll remained immense. Enslaved people who were mortgaged or insured lived under constant threat. Illness, escape attempts, or injury could not only endanger their lives but also destabilize the financial arrangements built around them. The very act of survival became intertwined with market calculations. Mothers feared for their children, not only because of the labor demands, but because their futures could be sold to satisfy a bank's ledger. Children grew up knowing that their value could be calculated, insured, and transferred without their consent. Some families resisted in subtle ways. Escape attempts, hiding, and avoidance of appraisal were acts of defiance. These individual acts remind us that human agency persisted even under the most dehumanizing financial systems. Yet the law was overwhelmingly on the side of profit. Courts upheld mortgages and repossession contracts, ensuring that banks and insurance companies could operate without moral or legal impediment. Enslaved individuals were legally invisible in these transactions. The Civil War would eventually disrupt these arrangements. Confederate defeat, emancipation, and the collapse of the plantation economy rendered much of the slave-backed credit worthless. Banks lost collateral, insurers lost policies, and planters lost their human property. Yet the financial practices developed during slavery left lasting impacts. Northern financial institutions, Wall Street, and insurance companies had already built wealth from decades of exploiting enslaved labor as collateral. This legacy influenced post-war investments, industrial growth, and the distribution of wealth for generations. The stories of families affected by these financial systems are heartbreaking. Diaries, letters, and court records reveal repeated seizures, auctions, and relocations of enslaved people to satisfy debts. In many cases, the individuals involved had no idea their lives were being used as security for loans. Imagine a teenager, bound and marched to a distant auction house, sold to a stranger to satisfy a debt he never incurred. These events were common, a constant undercurrent of fear and trauma intertwined with the Southern economy. Northern investors often remained detached from the human realities on the ground. While they collected returns from cotton, rice, and sugar, the lives that generated this wealth were counted in ledgers, not in human terms. Wall Street firms built fortunes on these arrangements, illustrating the extent to which slavery was embedded in American economic development. Modern narratives often separate Northern industry from Southern slavery, but the financial records show they were intimately connected. Repossession cases further highlight the human cost. In Mississippi, a planter defaulted on a loan secured by 75 enslaved individuals. Bank officers seized the workers, splitting families across plantations. Children were sent miles away from parents. Husbands and wives were separated. Such occurrences were not exceptions. They were routine outcomes of a system in which enslaved people were treated as movable property and financial instruments. For many planters, this collapse was devastating. Southern banks had lent millions, secured by enslaved individuals whose labor produced immense wealth. When the enslaved were freed, those loans could no longer be collected in full. Credit markets froze and many plantations went bankrupt. Yet the financial loss was concentrated among the planters and banks. The formerly enslaved bore a human toll far heavier than financial statements could capture. Families who had been repeatedly mortgaged or auctioned now faced economic precarity and freedom, often without land, resources, or legal protection. The social consequences were equally profound. Communities that had been subjected to repeated repossession, separation, and sale struggled to rebuild. People returned from auctions to find relatives gone, parents absent, or siblings missing. The financial mechanisms that treated their lives as collateral had systematically disrupted kinship networks. Even after emancipation, these fractures persisted. freed people faced systemic obstacles to reclaiming property, establishing livelihoods, or securing compensation for the exploitation they had endured. Through all of this, enslaved people demonstrated resilience and courage. They maintained communities, preserved family ties when possible, and resisted dehumanization in countless ways. Despite being treated as financial instruments, they preserved their humanity, passing stories, songs, and knowledge across generations. These acts of resistance remind us that the currency of flesh could never fully erase the personhood of those exploited by it. The end of the Civil War brought emancipation and a seismic shift in the Southern economy. For enslaved people, freedom came at last, but the financial systems built on their lives left deep scars. Banks, planters, and investors who had relied on human collateral suddenly faced the collapse of an entire asset class. Mortgages backed by enslaved labor were rendered worthless, contracts were voided, and insurers discovered that the people they had insured were no longer property. The currency of flesh, once the foundation of vast fortunes, evaporated overnight. Historical documents reveal specific cases of families caught in this transition. One Mississippi family, repeatedly mortgaged before emancipation, suddenly found themselves free, but with no land, no access to legal recourse, and no recognition of the debts previously pledged over their heads. Formerly enslaved parents struggled to reunite with children sold across multiple plantations. Freed people had to navigate a society that had treated them as property for decades, while attempting to survive in a world where financial and social systems were still stacked against them. The broader economic implications were immense. The collapse of slave-backed credit destabilized Southern banks, contributed to the post-war economic depression in the region, and reshaped national finance. Northern investors who had profited from slave-backed loans were less affected, having diversified their holdings. Yet the wealth generated from centuries of human collateral had already flowed into Northern and international institutions. Slavery's profits were embedded in American industry, banking, and infrastructure, leaving a lingering legacy of inequality. Formerly enslaved individuals sought ways to regain autonomy and financial stability. Sharecropping and tenant farming offered one path, but these systems often perpetuated cycles of debt and dependency. In many ways, the collapse of slave-backed credit shifted economic vulnerability from formal contracts to exploitative labor arrangements that were legally free but economically constrained. Banks no longer owned human collateral, but they still held sway over access to credit, loans, and property in the post-war South. The legacy of financial control persisted. Insurance companies, too, were affected. Policies that once insured enslaved lives were now void. Companies that had profited from insuring human property lost their assets overnight, revealing how deeply their business models were entwined with slavery. Some insurers attempted to adjust by offering new products to freed people, but these efforts were often exploitative, charging high premiums for minimal protection. The shadow of the insurance industry's past profits remained, and the financial exploitation of slavery left lingering ethical and social questions that endure today. Resistance and resilience persisted amid these systems. Enslaved individuals preserved kinship networks, cultural traditions, and knowledge, even when banks, insurers, and planters attempted to erase their humanity. After emancipation, freed people built communities, sought education, and established institutions that countered the legacies of commodification. Yet the shadow of financial exploitation remained, shaping the economic and social terrain in which they lived. The modern reckoning with this history is ongoing. Scholars, activists, and institutions are tracing the financial roots of slavery to understand contemporary inequality. Museums and archives preserve the contracts, ledgers, and insurance policies that once treated human beings as collateral. These documents provide stark evidence of the dehumanization inherent in the financial systems of slavery, reminding us that economic growth was, for centuries, built on the exploitation of human flesh. The long-term effects extend even further. Modern financial institutions, industrial growth, and wealth accumulation in the United States were built, in part, on the systemic exploitation of enslaved people as collateral. Studies tracing the origins of capital in early America reveal that banks, insurers, and investors who engaged in slave-backed loans laid the foundations for enduring economic disparities. The currency of flesh did not vanish with emancipation. Its influence persists in patterns of wealth, land ownership, and access to financial resources. Examining this history also highlights the moral dimension, the reduction of human beings to assets, the legal enforcement of collateralization, and the repeated repossession of families underscore how deeply economic rationality can dehumanize. Enslaved people's labor and lives were instrumentalized for profit, leaving behind both material wealth for some and generational trauma for others. Financial systems, often viewed as neutral or technical, were profoundly complicit in human suffering. As historians continue to uncover the details of this hidden financial system, the lessons remain urgent. Slavery was not only a system of labor, it was a sophisticated economic apparatus that commodified human lives. Banks, insurers, and investors played central roles, profiting from the bondage of others. Recognizing this history forces a confrontation with the moral and economic foundations of wealth in America, highlighting both the ingenuity and resilience of those who were enslaved and the deep ethical costs borne by a society built on human collateral. Even today, discussions about reparations, wealth inequality, and the role of historical finance in systemic oppression are tied to the practices explored in this documentary. The mortgage of human lives, the insurance of enslaved people, and the profits accrued by banks and investors are not mere historical footnotes. They are foundational elements in the story of American wealth. By confronting this history, society can better understand the long-term consequences of treating human beings as collateral. Ultimately, the story of slave-backed finance is a story of resilience, exploitation, and moral reckoning. It is a story in which the lives of men, women, and children were measured in dollars and cents, bought and sold to secure loans, and leveraged to build fortunes. It is also a story of courage, community, and survival, in which enslaved people maintained their humanity despite being reduced to currency.